Good afternoon. I'm Kathleen Chow, Program Manager of the Walnut Creek Library Foundation, and I'd like to welcome you to our virtual Finance 101 program, Tax Planning for the Remainder of 2022 with Ward Pynn. I'd like to thank our media and print sponsors, East Bay Times and Minuteman Press Lafayette. Ward is a graduate of the University of California at Davis and began his tax career at the National Office of the IRS in Washington, D.C. After returning to California, Pynn was employed at the Big 8 accounting firm before co-founding the local Walnut Creek CPA firm, RGP, LLP. Pynn specializes in individuals, trusts, and tax-exempt organizations and has presented seminars on many tax subjects. Today, Ward will provide advice and guidance regarding your tax liability for the remainder of 2022. He will discuss your options, including opportunities with taxable income, adjusting investments to include tax-exempt income and real estate investment trusts, maximizing deductions, consideration of Section 1031 exchanges for real estate and capital losses. He will also cover personal budgeting and discretionary expenses. If you enjoyed tonight's program, please consider making a donation to the Library Foundation to support their programs. Visit their website at www.wclibrary.org to donate, or click on the link located in the chat box. Following our presentation, we will have a brief Q&A. You can submit your questions for Ward in the Q&A box at any time throughout this presentation. Without further ado, please join me in welcoming Ward Pynn.
My name is Ward Pynn. I'm with the CPA RGP. We want to take really good people living by others. We have a number of subjects to go over today.
So at that time, a married couple that was subject to the 50% tax bracket was paying $30,000 on the first $85,000 and 50% thereafter. So that was quite a change for taxpayers, and certainly President Reagan and the folks that he worked with in Congress are to be complimented on what they did. And I will point out to you that at that time, the Democrats were in charge of the House of Representatives. Richard Gephardt was the Speaker of the House, and Dan Rostenkowski, a Democrat from Chicago, was the chairman of the House Ways and Means Committee. And both sides of the aisle worked together to pass the 1986 Act. I personally think that those rates, particularly for individual, were very favorable. I didn't like the capital gains tax rate at the time, but that was a trade-off. But what was really important in this particular legislation was that there is a cost of living adjustment on very many items within the tax code, including tax brackets and where they were at that time. So if you think about it this way, from an inflationary standpoint, that when you had a 85,000 of income in 1986 at a 50% tax rate, if there had been no cost of living, your income was at 226,000 in 2022, that would show a significant amount of increase, but just think of how much of that at an 85% floor would be absorbed by a 50% tax rate. So really the cost of living increases that were provided in that legislation are probably the most important as far as I'm concerned in this day and age. In November, the IRS will produce their annual cost of living increases for 62 different provisions of the code that are subjected to the COLA adjustments. Now, of those 62, I will admit that 16 of them are penalty provisions. So, and to date, we have not seen anything ever go down. In 1993, the Omnibus Budget Reconciliation Act was passed, and it provided an increase of the Bush era tax rates of 31%. It went all the way up to 39.6%, and it removed the wage limit on Medicare taxes, which resulted in a 1.45% tax rate on all individuals, on all of their wages and all of their self-employment income, as well as the employer portion. That was passed in the House by 218 to 216. All the Democrats voted for it. All the Republicans and 41 Democrats voted against it. So you're starting to see a little bit of a shift from a partisan standpoint. In the Senate, it passed 51 to 50 as the Senate was split between Democrats and Republicans. The 2007 Tax Cuts and Jobs Act lowered the 39.6% rate down to 37%. It lowered the corporate income tax rate from 35% to a flat 21%. It doubled the standard deduction. It eliminated personal exemptions. We are dealing with it today. And because of the way Congress passes their bills with respect to spending, it was only effective until 2025, which is right around the corner. And hopefully, Gordon Baker will talk a little bit about the estate and gift tax exemption and where it is right now and where it is possibly going to be in 2026 that people need to pay attention to. The 2017 Tax Act was passed all by Republicans, all voting for it, and Democrats all voting against it. So what we have seen from 1986 to 2017 is a definite departure from a nonpartisan collective legislation. Now let's jump into tax savings. Federal tax planning, not an easy area, but first let's talk about how many really get to itemize their deductions nowadays. The Tax Cuts and Jobs Act limited state and local taxes to $10,000. This has adversely affected California as a whole and 6 or 7 other major states, because the state tax deduction has been a very large deduction for individuals living in high tax states. Nevertheless, there are other things that are in here that we will deal with. With respect to deferring income, it's not uncommon for people to be paid bonuses and to be informed about them towards the end of the year. And so the question then becomes, well, should I have the bonus deferred or postponed into the next taxable year if I'm going to be in the same or a lower in tax bracket? There are downsides to deferring. And one of them is no one has a crystal ball as to where things are going to be at for sure for themselves in the following year. You also have the issue of inflation and what sort of effect that will have this year and the following year. And sometimes promises aren't kept. And suppose the bonus that you could have gotten in December is just, well, gee, we had a bad year after all when we got all the numbers in the following year, so you don't get it. Well, those things happen. There's also Congress. In the 1993 Act, there was an increase to not only income taxes rates, but also to estate tax rates. And so if you had an estate that you were handling for someone who died between January 1 and August the 10th of 1993, you would be surprised by having the estate tax rate that went up being retroactive to January 1, 1993. And these retroactive applications of tax law have been upheld all the way to the Supreme Court. So what are some other things that you can do from deferring income? You can maximize your contributions to your employer's 401k plan and other qualified plans. You can maximize to the extent you can because of adjusted gross income limitations to your IRAs, $6,000 per person per year, up to a certain amount. And that is typically $120,000 for a married couple. You can also contribute to a non-deductible IRA. Now that won't decrease taxable income, but the earnings on it will be tax deferred until such time as you withdraw it. But why would a person do that when the Roth IRA is available? Because a Roth IRA, while you pay taxes on it, on that amount during the year, you can set aside $6,000 a year if you're below the adjusted gross income cap on an annual basis, and if you have compensation. Certainly, IRAs, 401k plans, Roth IRAs, they all depend upon compensation that you have received, not investment earnings. What about your securities? Where are they today? If this were December of 2021, we'd say, gee, we're looking pretty good. Since that time, there has been a decline in the markets, and many people have seen their value of their assets decline significantly. So normally I would say hold on to your highly appreciated securities, especially if they're long-term, in order to defer income on them. But this might be a year in which, if you have capital gains in a taxable account, you may want to offset them with losses that you otherwise wouldn't take. Now, if indeed you do sell publicly traded securities at a loss and you really like that stock, you need to keep in mind that there's a 30-day wash sales rule that basically says if you sell your stock at a loss and you reacquire that stock within 30 days, the original loss is going to be disregarded. And I've seen all the brokerage firms on their 1099 detail, and by 1099, I mean the form 1099 that you receive as an investor that shows your interest, dividends, capital gains, and the like. Those capital gains schedules will show the wash sales. Now, if you invest in real estate and you have a rental, and you've held it for a good period of time, then you may think, well, gee, do I sell it now while prices are significantly higher than they were when I bought it 15 or 20 years ago? Or what? Do I want to pay the kind of capital gains tax rate combined that is going to apply to a California taxpayer? Because we're talking about a 15% tax rate at the minimum. You get above a certain threshold for adjusted gross income, there's another 5% tacked onto that. And then when you get over another adjusted gross income level of investment income, you pay 3.8% on top of the 20%. So altogether, you add up the federal income tax rates, which could be as high as 23.8%, but effectively 21 to 22%. And you add that to the California income tax rate, which when you're talking a 20% capital gains rate, you're really talking at least a 10.3% California tax rate. You add those rates together, you're going to be sending checks to the IRS and to the Franchise Tax Board in the neighborhood of 32 to 34%. I have seen this many times, but there is a way to defer it, and that is to use Section 1031 of the Internal Revenue Code, which requires that you enter into a fairly strict set of requirements that have to do with timing, and you replace that property, that investment property, with another property, and you can postpone all or much of the capital gains depending upon your particular fact pattern. And I'm not going to go into any detail with respect to that whatsoever, because you could spend hours. I know of continuing professional education and instruction programs that spend a couple of hours on just this topic alone. I will share with you, though, that this region is blessed to have one of the very leading 1031 experts right here in Lafayette. Another thing that you can do to postpone or minimize your income is to invest in real estate investment trusts, REITs. These are trusts that invest in commercial property of a wide variety. You've heard about the big ones, Prologis, Welltower, some of those. The advantage that a person draws from that, from the 2017 Tax Act, is that 20% of the dividends that you receive from them constitute qualified business income and become a deduction from your adjusted gross income. So those are just a few of the things that you might want to consider from a deferral of income standpoint. And now let's take a moment and go back to, your regular income tax return, which shows gross income, adjustments to gross income, standard deduction or itemized deductions, qualified business income, QBI deduction to arrive at taxable income. So you want to, at the outset, after you have deferred whatever income you can, you want to maximize your adjustments to gross income. What are we talking about in this arena? What we're really talking about is the kinds of payments, expenditures, deductions, whatever you want to call them, that Congress has seen fit to reduce your gross income by. And frankly, for individuals, the only ones that we really see are contributions to IRAs and health savings account contributions. And that's for employees. But for small business owners, sole proprietors, file a Schedule C. They're the sole owners. Partners in partnerships, shareholders in S corporations, and members of limited liability companies, and that's multi-member LLCs. What we do see as adjustments to gross income, but not as adjustments to self-employment taxes, are 1/2 of the employment tax, health insurance premiums, contributions to qualified plans, and again, HSAs. I will share with you that health insurance premiums can really add up. And you know that health insurance costs have not come down at all as a general rule. But this also includes dental, vision, and long-term care. So if you're a Schedule C filer or an S corporation shareholder, where you've already recognized those premiums as income, be sure to make sure that your adjustments to gross income include those kinds of deductions. So once you've calculated your adjustments to gross income, you subtract that from gross income and you get the beginning part of taxable income. Not a whole lot of people can claim the qualified business income. Employees cannot claim them, but partners in partnerships, S corporation shareholders, and members of multi-member limited liability companies can, but there are significant gross income limitations on those, as well as the usual suspects out there that we won't go into detail on. Now, having talked about adjusted gross income, why is adjusted gross income important? It's the starting point, if you will, for the deductions that you can claim. Medical expenses as itemized expenses don't come into play until you've exceeded 7.5% of your adjusted gross income. Charitable contributions are based upon adjusted gross income. Oh, but for the most part, we don't see the 60% of AGI as a limitation on most of our clients. Deductible IRAs are based upon adjusted gross income. Annual Roth IRA contributions are based upon AGI. Child credits, education credits, and a host of others. For a list of items that are subject to AGI limitations, it's best to take a look at the annual IRS revenue procedure that identifies all of them. Now, for those of you who might not admit to it, but are 65 or more, and you're getting Medicare, Medicare imposes a surcharge when a single person's modified adjusted gross income is 91,000 or more, or a married couple's is 182,000 as AGI. And notice I said modified adjusted gross income. If you think that tax exempt securities that you have through California municipal bonds and the interest you earn on that is going to keep you out of that AGI limitation, you're wrong, because it's your tax adjusted gross income plus tax exempt interest. And there's some others that are in there that we won't go into detail at this particular session, but are going to be in the handout that we provide. Now, what does that mean? That means that you will be paying more each month in your Medicare premiums. And the highest income level for married couples would subject each Medicare beneficiary to another $580 a month, which adds up to close to $7,000 a year. We have seen this. It's there. It's called means testing out there in the real world. It's called a surcharge by Medicare. You can see the chart on the Social Security Administration's website, or you can ask for it from your tax person. Now you want to get to the determination of whether or not you can itemize deductions or if you should claim the standard deduction. As I noted earlier, the Tax Cuts and Jobs Act doubled the standard deduction. That's subject to inflation, and I should say cost of living increases, and it did away with personal exemptions. It did increase child credits to a certain extent, but it's an area that you have to determine what is really out there for you. And there's really only 3 itemized deductions that really come into play for the majority of people who itemize. One thing statistically is that up through 2017, only 25% of taxpayers itemized their deductions. With the standard deduction coming into play in 2018, all of a sudden, that fell down to 10%. So if you own your own home outright, and you've lived in the same place for a long time and don't pay much in property taxes, let alone state income taxes, you'll probably be better off with a standard deduction unless you give serious dollars away to public charities, churches, schools, and those kinds. So what does it mean when you are subject to that $10,000 state and local tax deduction, also known as the SALT deduction? Basically, what it means is you have to consider not only this year, but next year to determine whether or not it makes sense to itemize. You need to look at your property taxes and your state income taxes, plus your mortgage interest, if any, and your charitable contributions to get over that magic number, which for 2021 was $25,100 for a married couple, and half that for a single person. So what it really boils down to is that you need to be paying attention to not only this year and next year, but you might historically take a look and see what your position was in 2021 and see where you can make changes in the next 3 or 4 months. It's better to do it now than to procrastinate until December. Now that's human nature. Yours truly has done that from time to time. But having said all of these things about limitations on itemized deductions for the federal level, keep in mind that California does not conform to all of the federal statutes. And there is a publication, Franchise Tax Board publication 1001, that identifies the differences between the 2 tax regimes. So if you don't itemize for federal, that should not stop you from considering itemizing for California returns. The standard deduction for a single person is $4,803. So if you're a homeowner, your property taxes and just your property taxes alone may be greater than the standard deduction. And if you have a mortgage, and if you're generous and you make charitable contributions, then there will be an additional amount of itemized deductions. In addition, those 2% miscellaneous deductions that went away with the 2007 Tax Act can come into play for you. I know that there was some consternation amongst the attorneys and the CPAs in the entire country when the federal temporary rule is that estate planning fees, tax return preparation and advisory fees, union fees are not deductible as miscellaneous expenses for federal purposes, although at present they're good for California, and they will be coming back in 2026 unless Congress, in its infinite wisdom, decides to change the tax law one more time between now and 2026. There are rules with respect to charitable contributions and some of the ideas that you might want to think about rather than just simply cash is to donate publicly traded securities that have appreciated highly in value. You can get a deduction of up to 30% of your adjusted gross income by donating your securities, publicly traded securities, at their fair market value to a qualified public charity. If you are over 72 and you have an IRA, you will be required to take a required minimum distribution. And there is an opportunity for you to eliminate or lessen your required minimum distribution that's going to be taxed by giving directly from the IRA custodian monies to public charities, such as the Walnut Creek Library Foundation and others. There are others here in this community, no question. As CPAs, we occasionally see medical expenses subject to the AGI floor being exceeded. If it's your only major expense, it would still have to get over the standard deduction amount collectively for it to be of any benefit to you. As I said, California is different, and you really want to take a look at that publication 1001 that you can find on the FTP website. Having said all of this, pay attention to tax brackets. You know, get a copy of the 2022 tax brackets from your CPA enrolled agent or your tax attorney, or from your neighbor, who knows? They might have one handy if they're, if there's something wrong with them. But in any event, take a look at tax brackets, because sometimes you will want to accelerate income into the current year and still stay within the tax bracket. Having said that, make sure that you have a taxable account in addition to whatever retirement plans and IRAs you might qualify for and have investments in there. Why do I say that? If you have the bulk of your liquid assets in an IRA and you're 72 years and you're any age over 59 and a half, when you can start taking out distributions without paying penalties, well, if you have something unexpected come up, if you have to take monies out of your IRA, that's all ordinary income. So what you want is a taxable account that hopefully will have significant unrealized capital gains in there. So if you do have to take money out, take it out of your money market fund or money market account, your savings account, a low interest bearing account, or sell some stock and be subjected to just 15 or 20% tax bracket. So that's why it's important to pay attention to tax brackets, not only this year, but next year. There's some speculation that some of the COLA adjusted rates are going to go up significantly next year. I have read that Social Security benefits may go up more than 8%. I've seen that from 3 different publications that have a good reputation. Similarly, Medicare will increase their rates. They use a different CPI methodology, and their increase rate-wise will probably be higher than any Social Security one. We are zooming along. We are at recent major federal and tax legislation provisions. You've all heard about the American Rescue Plan. I'm not going to talk about that here. The Infrastructure Investment and Jobs Act. Not going to talk about that here. Do want to talk about the Inflation Reduction Act. That bill that was signed just about 30 days ago passed the House and the Senate with all the Democrats voting for it and all the Republicans voting against it. Passed the Senate 51-50. Now, I think that the budget, that the Inflation Reduction Act may have been misnamed. Okay. That's just me taking a look at it. There are some provisions in there that will surprise you, but one of the ones that I wanted to talk about right away is the IRS budget. You have seen in the news that $80 billion has been appropriated for the IRS. The IRS's current budget is right around 12.8 billion. They have anywhere between 76 and 84,000 employees, depending upon what you're reading and when you're reading it. But I think what's really instructive is that this $80 billion is spread out over the next 9 years. That was passed so late this year that it will only be able to, they will only be able to spend 5.2 billion in the current year. It takes a while to get employed by the IRS, let alone trained. 45 billion of the 80 billion is for enforcement. So there's been some speculation about, the IRS agent is going to come knocking on your door. And there is, to a certain extent, that there. But in the first 4 years through 2026, the IRS is only allowed to spend $21 billion. And this is really a back-end loaded appropriation. And who knows what Congress is going to do in the next 2 or 3 years. Personally, I think one of the things that the IRS will do, because they can do it quickly, is that they should be able to hire enough people to be able to man the phone lines. Only 8% of the telephone calls got through in the last year. And that is the biggest complaint that taxpayers give to their congresspeople. So I think the IRS will do something about that. Revenue agents and everybody else like that takes 1 to 3 years to train them properly. And well, you may have heard that there's going to be 87,000 people employed through the extra dollars. What is generally not known in the general community is that there are 50,000 current IRS employees who qualify to retire in the next 5 years. I would invite you to read the Congressional Budget Office that talks about the IRS budget. Can't see it, can you? Okay, well, we'll put a reference to it in our document. One of the things that is very instructive is, okay, am I going to be audited now that they've got all those new people that are coming on board? Okay, well, there has been some discussion that nobody making under 400,000 is going to have any tax increases. Well, there are no rate increases per se, okay? But this is what Janet Yellen, the Secretary of the Treasury, said in a letter last month to Commissioner Chuck Reddick of the IRS. She said, I write today to confirm the commitment that has been a guiding precept of the planning that you and your team, meaning the IRS, are undertaking, that audit rates will not rise relative to recent years for households making under 400,000 annually. Specifically, I direct that any additional resources shall not be used to increase the share of small business or households below the $400,000 threshold that are audited relative to historical levels. Very interesting. That's the audit rates. And I will share with you that Syracuse University takes a look at a lot of the IRS data that the IRS publishes. And they have some interesting stats. I will simply share with you that more than 75% of the audits that the IRS conducted in fiscal year 2021 were office audits. That's where you get a letter from the IRS on a specific item. but less than 150,000 audits were field audits, where they come to your office or to your CPA's office or your tax attorney's office and audit your books and records. What is striking is that there's a very small percentage of high net worth individuals who are being audited. And therefore, the rate of audits may be maintained according to Secretary Yellen. But if there are a lot more auditors, then your chances of being audited and having your taxes increase do rise greatly. Well, it's hard to believe I've been, probably boring you to tears for the last period of time. But I did want to just say that there will be information about the hidden tax of inflation. And I will share with you one of my favorite coins. This is somewhere in here, a 50-cent piece, okay? You don't see them very often, okay? California's fuel tax, every time you go to the gas station and fill up with fuel, well, it just went up on July 1 to 53.9 cents a gallon. And that does not include the 2.25% of sales tax that's on the total retail value of the gas that you pump. And your federal excise tax, highway tax, is 18 cents a gallon. So when you see the high prices for California taxes, keep in mind that it's partly California's fault. So I only show this $50 because that's 10 gallons. Figure 10 of these, they get kind of heavy, okay? It's also to reflect the fact that since inflation, when the Federal Reserve Board was created in 1913, that this $50 represents a 1913 penny because of inflation at 95 to 98% since 1913. Well, I really wanted to get and spend some time talking about student loan forgiveness, but you'll have to forgive me. We'll have some commentary in our preparation for you. So what I'd like to do at this time is to see whether or not we have any questions. Okay, here's one. I am retired with no income except investments. I haven't started Social Security yet. I did the Roth conversions for about $350,000, which still leaves me at the upper end of the 24% federal bracket and 10.3% for state. Today was a good day for Roth conversion. Am I doing it right? As long as you have the fiscal wherewithal to pay the taxes that's going to be on that additional $350,000, and you don't have to withdraw it from, say, your IRA, and you stay within the brackets you want to stay in, then do it now with the understanding that there's no guarantee that your Roth IRA will go up in value over time. You need to make sure that you have invested your Roth IRA wisely, and it's not a bad idea at all to get financial help from an investment manager or financial planner. Okay. Next question. Can I pay taxes in December of this year for all the 350K Roth conversion? The answer to that is yes, you can. Again, make sure that you have the financial wherewithal to pay those taxes. One thing that you might want to do is to run a scenario about the taxes that you would pay this year by getting a tax software from 2021, or by lining it up with your 2021 tax return. Okay. Here's another one. I finally got around to doing my tax returns using tax software package I bought. I had made an IRA contribution of $6,000, and when I ran the final version to file, I did not get a deduction for it. Why? Do I have to take it out because it wasn't deductible? The why is because there's a fairly low adjusted gross income level that you must have exceeded. For a married couple filing jointly, it's $120,000, unless it was if it was for you and you were covered by an employer plan. You really need to take a look at the booklet that the IRS has on IRA contributions and distributions. That sets forth all of the various limits as to why it would be non-deductible on your tax return. You'll still have to show a Form 8606 on your return that you report it, because you don't want to lose track of that $6,000. That $6,000 gives you basis for when you start withdrawing from your IRA. There is a fractional formula that's set forth on the Form 8606 so that you can see in rough terms, in comparison to the fair market value of the year in which you start with take money out, how much of whatever you take out is going to be reduced by a small amount of that $6,000. Now, do I have to take it out because it wasn't deductible? The answer for traditional IRAs is no. There is a different answer for Roth IRAs. Even if you've paid the tax on the Roth IRA and you go above the adjusted gross income limitation for making a $6,000 contribution, you are supposed to have it taken out by your IRA custodian, but you are the one that has to tell them. Here's another one. I just started getting Medicare this year, and I sold my house for a lot more than we paid for it. My wife and I do qualify for the $500,000 exclusion, but we will still net more than $400,000 in taxable gain. My neighbor told me I probably messed up my Medicare premiums. What was she talking about? She was talking about the Medicare surcharge that we talked about earlier. If your adjusted gross income, modified adjusted gross income as a married couple is more than $182,000, you will be paying more 2 years later. So if this sale occurred in 2022, plan on your Medicare payments in 2024 being increased by whatever the surcharge would be in that particular year. Finally, and this is the last question that I see on the screen. Back in January, I was worried about the market. Too many Larry Kudlow shows, I guess. Joker. I sold a bunch of stock and I'm sitting on $40,000 of capital gains. Is there anything I can do to lower the tax bill for this year? You didn't say whether or not they were short-term or long-term, but you would simply apply the tax rate that you would be in, 15% in this case, to that to determine your tax liability. But if you have unrealized losses, this would be an excellent example of what I talked about earlier of harvesting losses. See what your unrealized losses are, sell them, get rid of the 40,000 in gains. Hopefully you don't have 40,000 in losses, but take whatever you can to reduce the tax liability that would result on net capital gains. Well, I think that's about all. Gee, I wish I had another hour. I would like to apologize for the technological hiccup that we had earlier. It does remind me of the time I was emceeing a program and the lights went out in the auditorium and the speaking speakers weren't working. That's an anecdote for a different time.